everyone, and welcome back to another episode of the Smart Money Show. My name is Liman Akhtar, and as usual, I'm joined by Ali Suleiman. How are things?
I'm good, bro. It feels like it's been a while since we've been in our studio. We've done a number of in-person episodes, which will be going out after this. I'm very excited for them to go out, but it's been kind of non-stop, so it's nice to be kind of back at our home studio and, back for a recap episode as well. But before we get into that and what we're talking about, how are things with you?
Yeah, all good. And of course, as you said, I think this is the first recap episode both of us have been on.
Yeah, for a long time.
Yeah, because I think once it was you, then it was me, then it was you. So yeah, it's nice, and we've got, of course, as you mentioned, a good few topics to run through as well.
Yeah, absolutely. So as usual, for our regular listeners and also our new ones, we're joined by our two resident experts, our Head of Equities and our Head of FICC, Fixed Income, Currency and Commodities, Ilett and Wahy Yahya, respectively. So before we get into their introductions and start talking about our topics today, what are we actually going to cover on this episode? So as usual, we kick off with US and UK macro and economic data. Then we're going to go into some more niche news per asset class, kicking off with S&P and UK performance. While he's going to talk about the credit flood of AI related issuance. We're also going to talk about bank losses in their earnings, Norway's oil fund versus Musk's pay deal, Microsoft earnings, and a few other FICC and equity niche news right near the end of the episode. But I'm very excited to, welcome both on. As Naman said, it's been a while since we actually had 4 people on this episode, so it's going to be a good conversation for sure. But how are you guys doing? Dylan, how are you?
Yeah, very good, thank you. Things are starting to sort of kick off now with final year, a lot of assignments, a lot of job hunting. But yeah, everything's going well.
Nice one. And Wahy, how about yourself?
Yeah, not too bad, Ali. Thanks for asking. It's been similar to Dylan, really. It's just been really applications for graduate schemes, and it's not easy. So yeah.
Yeah. No, absolutely. I think we're all feeling the heat a little bit, but it'll pay off in the end. Fingers crossed for sure. Noman, I'm going to let you kick off kind of the first sort of topic of the episode, if you want.
Yeah. So of course, as you guys know, we always start off by, a bit wider. We're going to look at US and UK macro separately. So I'm going to start with US macro, and we're going to go Dylan. So talk to us then, Dylan. What's been happening in the US on the past month or so, and what are markets like?
Yeah, of course. So, I mean, the big headline is the US government shutdown, which was because basically Congress couldn't pass an agreement on fiscal spending and government spending, and obviously this has brought a halt to many services in the US, including there's issues over airports, there's issues over many sort of government entities that report various economic datas. And obviously, this is not a great situation for the US to be in. So that sort of clouded what's been going on in the US. But from a data standpoint, we've seen inflation, the PPI at 2.8%, which has shown some relatively decent signs of inflation cooling. But obviously, with the government shutdown and other issues, it's not 100% sunshine and rainbows. But however, we saw Jerome Powell actually cut the US rates on the 29th of October to a rate of 3.75 to 4%, which is obviously good signs, but obviously there's still concerns over employment and obviously persistent inflation. So with this government shutdown, it's been very difficult to actually find some concrete data on what's happening with employment, but it's actually estimated by various private sector estimates and analysts that with the government shutdown we have over 900,000 employees in the US furloughed, which is obviously not going to be good for the economy. And obviously if that continues to spark various unemployment rates, then obviously we might no longer see any more rate cuts towards the end of the year. So that's what we've been seeing in the US so far.
Interesting. And in your own personal opinion, as you've mentioned data and what that might mean for the Fed's next move, but in your own personal opinion, what do you actually think we're going to see from the Fed before the end of the year?
Yeah, so obviously markets are relatively optimistic that we will see another cut. And Jerome Powell has been very sort of hard to read in recent times. Obviously, we know we have his good afternoon and hello everyone, but actually he has alluded to multiple things in his most recent meeting that a December rate cut might be unlikely. but obviously this will be entirely based on economic data. And I think if we continue to see some pullbacks in inflation, then he will be inclined to drop rates. My personal opinion is that he will. But I think it's very 50-50 at the moment, given all the uncertainty over the government shutdown and just general market movements.
Exactly. And I know the shutdown has been very widely talked about, especially because it is Trump's government, so everything's kind of a bit exaggerated. But I bet a lot of viewers didn't know that it's actually not the longest shutdown in US government history. And I think it's the way it's been talked about, it makes it seem like it's the longest, but it actually isn't. I think there's one or two that are longer. So we're still, it isn't the best, but we're still under that threshold for now. But it does mean everything's a bit slower for sure.
Yeah, and of course the coincidental factor that it's the last shutdown was also in Trump's presidency as well, back in 2018, 2017. But you're going to probably have to correct me on that. But anyways, so now moving on to UK macro data. So Wahy, now talk to us about the year UK economy and the data points we've been getting over the past 4 or 5 weeks.
Yeah, sure. So I mean, to put it into perspective here in terms of the big picture, the growth is okay. It's not good. It's not necessarily bad, but the quality of it is actually quite poor, and that's because of the current account, which I'll get into a bit later on. But in terms of what we usually look at first is it's going to be CPI, and it's unchanged since July, August, and we're going to get the next reading for the next look on the 19th of November. So that will be for our October CPI. Market consensus is still around 3.8%. However, we are expecting Q4 CPI to be at around 3.7%, following 2.5% in 2026 and then 2.1% in 2027. Now, these forecasts allow for the central bank's target to be close as possible to 2%. However, the IMF thinks that the UK's inflation will be at its highest in 2025 and 2026 as we go towards the end of 2025, going into 2026 rather, being 3.4% and potentially even being 2.5% in 2026, which basically just means that inflation is stuck in the high threes. It's not essentially a crisis, but is almost double the target, which is definitely a concern. And so I guess in this case you can say that core and services are actually the problem, as they reflect wage growth, not just like oil, food, or even the volatility in that price action for that matter as well. And it's put the UK in a position where it's now become an inflation outlier. As we know, it's a first world. It's part of the rich world. As you know, according to the IMF, that actually matters for rates, especially the sterling as well. And now markets are actually realizing that bringing inflation down from 4% to 2% is quite painful. But I guess you can say in a way that grinding is actually part of the journey in this case. So when we move on to consumers and trade, we got retail sales volumes at 0.6%. In August, went down to 0.5% in September, and it's the fourth straight monthly rise, and it's the strongest level it's been since 2022. We spoke in the last episode about household and how household savings actually changed. So the household saving ratio is now at 10.7% versus 10.5%, and it's, I think it just emphasizes the point I made prior, where their room for discretionary spending is actually decreased. So you're looking at more saving rather than just spending for household consumers as well. Now, we usually talk about the banks as well in the UK. So obviously we know the Bank of England's bank rate is at 4%. It's held, this was from the last meeting. Markets are actually split on whether we get a 25 bip cut at November, and we always like to refer it to smart money itself. So Goldman Sachs now expects a trim on this, and others on the street are waiting for cuts until 2026. So when we talk about cuts, we are still talking about cuts, and we are pricing in physical risk here, and that's essentially why the curve is actually relatively steep in that case.
Yeah, absolutely. And a similar follow-up question to the one I asked Dylan, you know, yourself being a regular investor and not a speculator within FICC markets, in your personal opinion, how have kind of bond and currency markets reacted to the latest numbers and readings from the UK?
Yeah, I mean, we can talk about banks actually really quickly. So obviously we know that a 4% bank rate is quite sticky with inflation. However, it does provide decent net interest margins for those banks in terms of when we're talking about rising credit risk, even if growth actually slows down going into 2026. And actually, for investors, the UK rates will remain higher for longer than the Eurozone, for example. As we spoke, it's higher compared to its peers, which actually does matter for sterling, and it allows for trades to be carried on. And the UK versus EU, that whole credit spread, you could call it like a clash if you want, the UK versus EU credit spread that we've got here. So yeah, I would definitely say that you can, in the credit side of things, actually benefit from something like this. And which we'll get onto a bit earlier when we talk about yields.
Yeah, amazing. I think that is like a really good overview of what's happening in both the US and UK. Of course, I think across the board is a very sticky environment. Whilst everyone really wants rate cuts to happen, so it is an interesting, and I think it's just the more forward guidance we get, then I think we can make a clearer picture. But anyways, so we're going to start getting a bit more niche now. So talking about the S&P now, of course, S&P screams your name, Dylan. So talk to us about the S&P 500 and the FTSE. How's that going?
Yeah, so I'll start with the FTSE. So it's actually been a very good year by UK markets are concerned. So obviously last year the FTSE struggled. It only returned roughly 7%, and the previous year in 2023 it could barely even beat the risk-free rate. So this year we've seen quite a contrast where the FTSE year to date is actually up 19%, and this has been fueled by a few things. So first of all, I've alluded to this quite a few times, valuations in the UK markets. The UK market has been severely undervalued for a long time now, and whether it has a basis for that because of there's instability in politics or there's instability in general economics in the UK markets have been undervalued, and there have been some companies that have been overlooked. In addition to this, we've seen some relatively strong earnings. So I said a couple podcasts ago that actually the UK market, the FTSE 100, is equally as concentrated as the S&P 500, but it's something that people don't really speak about. So for large, big hitting stocks like BP, AstraZeneca, Barclays, a lot of the banks have actually had a very good year so far. So that's actually pushed the FTSE 100 up quite a bit. And obviously, from a month-to-date perspective, we've had a slight pullback, but we're actually expecting some more positive gains from the FTSE because we're going to see some corporate earnings coming from those large companies. And of course, as Wahy was saying, we are anticipating a potential rate cut in the UK. So it's going to be a good year for the FTSE 100. I don't see a drastic drop off, and I think anything in double digits in terms of percentage return for the FTSE 100 in the current market is a strong return. So actually it's been quite a good year. And again, same for the S&P. So obviously towards the start of the year we saw the S&P actually underperforming the FTSE 100, which investors almost had to pinch themselves because, as I said, it's a rare occurrence. And obviously that's been boosted by strong earnings and economic growth. But obviously there's been a lot of volatility in the US market due to tariffs and obviously due to various trade deals and other corporate earnings. So it would be an interesting one to see what happens towards the end of the year. I think it's very dependent on what happens with Jerome Powell and how this government shutdown affects things. And also we've still got some extremely large tech earnings to come. So if we see some positive returns in that space, then obviously that will obviously carry the S&P 500 forward, potentially into new highs. So that's a brief overview of what we've seen in two of the largest equity markets.
Yeah, absolutely. And you answered like 2 or 3 of my follow-up questions, Dylan. So I'm just going to move straight on because that was brilliant. And Wahy, it's back to you for another niche topic. And it's actually probably the most niche FICC-related topic we've had on the show so far, which is credit flood of AI-related issuance. Now, it's not something I really knew a lot about when you shared it on the topic list. I had to do my own personal research into it. But what is behind the surge in AI-linked bond and credit issuance? And for viewers and listeners that don't know, including myself and probably Naman, what actually is it?
Yeah, I mean, to start off with, I think we need to actually mention AI a lot more when it comes to markets. It's something that's prevalent in today's day and age, and we actually use it quite frequently. the average person who isn't a Luddite would actually want to use AI just for daily use. And I think we should definitely talk about it a lot more in markets. So yeah, when we talk about AI related issuance here, it's corporate bond deals and some loans that are raised specifically to finance large scale AI infrastructure. So we're talking data centers, GPUs, processors, cloud capacity, even networking, and etc. and etc. So in terms of like the actual fact itself, the FT estimates a roughly $200 billion of AI linked bonds and loans, and they've actually hit the market in the last year. So big tech in this case is leading it. When we talk about large US stocks, Nvidia, your big tech companies essentially here. We're talking about US mega caps and chip makers as well, and including Meta's $30 billion multi-tranche bond for AI capex as well. Now, when we talk about maturities here, they're actually stretching quite long, and then there's plenty of it actually. Speaking of, we've got 10 to 40 year on paper, and they're often issued at tight spread thanks to the strong demand for anything that's AI themed in this case, and a lot of supply is actually investment grade as well. But one thing to note here is that there's actually a second wave in high yield, smaller with regards to smaller data centers and operators. When we talk about like cloud adjustments and some of the biggest names when it comes to cloud adjustments as well. Now, this is the capex side of the AI boom, and we obviously the equity analysts could talk about earnings and how it's actually flooding the market. And I'm guessing when we talk about the near term as well, supply is actually soaking up demand quite nicely, to be fair. And investors want duration and AI exposure, but it concentrates the risk at the same time in a single theme. And you can understand why. It's because we're actually using it so much. We're using it quite heavily. And so when we talk about IG investors in this case as well, their focus kind of shifts from headline AI story to more of like a cash flow visibility. Obviously, Dylan covers this a lot more than I do, so he can actually probably confirm if I'm right or wrong in this case. But I think a question that I've asked from this is: are these projects self-funding, or is there like actual capex pits in this case? And so for HY, the danger is actually capital structure layering in this case. We've got secured bank debt plus bond deals on top with minimal covenants because everyone wants into AI. And from like a macro angle in this case, a $200 billion AI capex wave is hugely pro-cyclical. So when we talk about the wider economy, the macro side of things, it's actually very good for growth. But however, one thing we have to do know is the risks. So if funding actually shuts, it can easily flip and drag on investment and potentially harm jobs, which wouldn't be good for the economy at all.
Yeah, that's really amazing, because if you think about like this scale of just 200 billion in the last year alone, it seems so like how is it going to this scale again? But then when you see recent trends like Nvidia topping 5 trillion, and if you just look into that order book, it's just insane the amount of demand out there. So it kind of does justify this credit flood that we spoke about at the top of this topic. So, but yeah, that is really interesting, and I think that's a great summary of that topic. So I'll move directly on then to bank losses. Now, Dylan, of course, we had a string of losses in the recent earnings seasons for banks. So talk to us about that. What happened and what's really driving this trend?
Yeah, of course. So we had a mixed sort of earnings, and we saw places like JP Morgan actually perform fantastically well. But actually, it came from quite a few sort of regulatory perspectives and also a few cases of fraud. So specifically today, we're talking about Western Alliance Bancorp and Xeon's Bank Corporation. And these are, for a bit of backdrop, these are regional banks on the west coast of the US, very close to Silicon Valley. And both companies here, so we've got Zion's Bank Corporation disclosed a $15 million charge off related to default commercial loans and a $60 million loss in provisions due to misrepresentations and contractual defaults by borrowers. Then we have Western Alliance Bancorp, who basically they lost 10% in their stock in one day due to loans that have been linked to fraud. So this has created pressures on a global scale. So we've seen banks like Barclays, HSBC, JP Morgan all record losses on their stock the same day that these announcements were released. And obviously this is introducing the systemic risk that we are seeing in banks in modern day. And it links actually to the Silicon Valley crash. And for a bit of backdrop again, when Silicon Valley crashed as a bank, Zion Bank and Western Alliance Bancorp, both on the exact following quarter, actually recorded higher deposits in their bank. And obviously that has come from people who obviously used to be with Silicon Valley Bank, various investors and customers that have moved over into those banks because they're in the same rough region. So Jamie Dimon actually made a statement here, and obviously he's quite concerned about this. He said, when you spot one cockroach, there are likely more. So basically he's indicating that there's likely hidden credit problems that we are seeing in these regional banks that could very well spark another crisis or another stream of losses for these banks. So what we saw spreading across to Europe, we saw Deutsche Bank, they were down 4.5% on the day. Barclays were down 3.7% on the day. So even though these are relatively small regional banks on a global scale, obviously this systemic risk does trickle through on a global scale, which obviously is creating relatively sort of scary thoughts for investors. And I think it's something that we all need to look at, because if there are sort of bad loans and risky commercial loans going out, are we going to see a repeat of 2007? Are we going to see a repeat of Silicon Valley Bank? So it's a shame that this is happening, because there was some really good earnings that we saw from our large retail and investment banks, but this has sort of clouded the good news.
Yeah, absolutely. And again, very interesting stuff. And I guess potentially not a lot of people expected that as well. I mean, it was similar to when SVB went down as well, which is interesting. I think it came up in our lecture recently as well, which is why I guess it was kind of running around our heads as well.
But there are also, I think, mixed views across the market as well. So we've got, I remember reading that David Solomon, he was saying that there's no systemic risk, is there? I'm not sure if that's outdated now, so maybe he's changed his mind. But so it is really interesting on that end, isn't it?
Yeah, absolutely. And Dylan, I think you covered it a little bit, but maybe in more detail. How have markets reacted to these results so far, and do they expect more to happen?
So in terms of the banks, obviously markets did react positively to their initial earnings, but obviously this came a couple of weeks after. And actually the banks have recovered. And the same sort of thing happened when Silicon Valley Bank collapsed. We saw sort of 9-10% drops on the same day, but actually banks recovered to their usual sort of remit within a couple of weeks. So obviously this happened sort of midway through October, and obviously it's sort of done news now to an extent. So markets obviously reacted negatively, but there's always going to sort of be a comeback in the banks, because obviously perhaps their fundamentals aren't quite as risky and affected as these obviously smaller regional banks. So it will be an interesting one to see if there's anything else that comes with this. We might see more losses on banks' balance sheets from a credit perspective, and that might introduce the idea that actually we are going through a situation that is very similar to 2007 to the Silicon Valley Bank collapse. But I think for now, I think it's sort of being brushed under the carpet until we see some new news on it.
Yeah, 100%. But at least we do have, these top firms, not as in at least taken to an extent, even if it's verbal ownership, so they're actually recognizing that, okay, there's a potential issue happening or potential crisis, unfolding. So maybe, there can some precautionary steps can be taken. But anyways, I'm going to move on to the next topic then, because that was super succinct. But so we're going to talk about Norway now. I know Norway's probably got one of the most iconic and well-known sovereign wealth funds out there. So Wahy, of course, as this being your topic, talk to us about Norway's sovereign wealth fund and the whole oil deal with Musk. So talk to us more about that.
Yeah, we've got another FICC and equities crossover as a niche topic. So yeah, Norway's oil fund, Naman, you are correct, is the world's largest sovereign wealth fund, and is a huge cross-asset investor as well. And their vote actually sends a strong governance and ESG signal to both equity and credit markets. And so the fund size is roughly $2.1 trillion, holding 1.1 to 1.2% of Tesla as well, which equates to about $17 billion worth. And it has announced that it will vote against Musk's proposed $1 trillion compensation package, which cites the size, dilution, and key person risk. And so advisory firms ISS and Glass Lewis are also recommending a no vote. Some active managers like Baron Capital actually support the plan as well. And so the vote is scheduled for tomorrow, which is the 6th of November, and Tesla shares have already wobbled on the headlines. Now, I mention this because we like to relate it as well back to FICC as much as it actually does impact equities too. So from a credit perspective, this is actually about governance and cash flow priority. And $1 trillion equity package implies huge potential dilution and pressure to keep equity valuations sky high. And for bondholders, key person risks, they cut both ways. Musk is the asset and the liability at the same time. Which is quite a hard concept to grasp. But if he leaves, then execution risk explodes. If he stays, incentives can skew and they can actually become a lot more aggressive. And so Norway's fund is actually opposing the deal, as they think it's actually symbolic. It shows even like the most long-term diversified institutions are actually drawing a line on supersized pay. Now, when we talk about FICC, we also like to relate it back to ESG too. So from an ESG standpoint, this is the governance part of ESG. It's action needs to be taken. So for it actually does matter for credit, because if poor governance is strongly correlated with tail risk events, then this can lead to like a misallocation of resources, legal trouble, and even accounting issues as well. And so my last point to make is, if the package still passes, then the signal would be that equity holders are actually willing to accept extreme key man exposure for upside, which could justify a credit spread premium versus peers with more conventional structures.
Yeah, absolutely. And again, you talked about, I mean, you mentioned shifting mindsets, and it's absolutely right. And it goes on to my next follow-up question, which is, what do you think this reveals about these kind of shifting governance priorities among these major investors? Because it is, it's a common thing that you see across the globe.
I would say, yeah, because to answer the question, I'm going to ask another question as well at the same time. Why should bond people care about an equity pay vote in this case? And so when we relate it back, we can say that it actually affects financial policy. You got leverage tolerance as well, and actually investor risk appetite. So yeah, I would definitely say it actually affects the whole global and macro perspective as well. And you can also relate this back to how Norway's stance could trigger further ESG backlash. And yes, it actually does. Because when we talk about European pensions and sovereign wealth funds, they actually follow Norway's lead as well. So yeah, it definitely makes a huge impact, both on peers and yeah, the wider perspective for both investors and firms too.
Amazing, and of course, I think it's on that with wealth funds, they're taking like such a different direction these days. I mean, everyone's heard of what's the Saudis public investment fund. They've been much more, I guess, riskless, I guess, if that's a nice way to describe it. So yeah, I think tomorrow will show a lot of guidance towards that as well. But anyways, so now the next topic we have is, of course, Microsoft's earnings. Now we had, I think, was the week commencing the 27th, or that was like a large earnings week. So Dylan, talk to us about that. What happened, and why did you want to pick out Microsoft for our topic today?
Of course, so Microsoft actually had a very sort of good quarter. So their revenue was up 18% year on year, reaching 77.7 billion, and also their EPS rose 13% on a GAAP basis, and on a non-GAAP basis it rose 23%. And they alluded to many of their cloud platforms growing, and they actually had a 370 billion plus backlog from their cloud, which obviously is showing demand in their services. However, they did also talk about a potential capex spend increase in AI investment, which actually caused the stock to drop. And we say it all the time, sometimes there's bad news in earnings, but little comments mean that the stock rises. Sometimes there's great news in earnings and little comments mean that the stocks drop. But there was actually one really key factor of their earnings that was actually quite hidden that I wanted to talk about, and it's related to OpenAI. So I actually have a quote here from one of their fine prints that they kept very well hidden, but someone found it nevertheless. So it says, we have an investment in OpenAI Global and have made the total funding commitments of $13 billion, of which 11.6 billion has been funded as of September the 30th, 2025. The investment is accounted for under the equity method of accounting, with our share of OpenAI's income or loss recognised in other income as an expense net. So Microsoft have a 27% investment in OpenAI, which obviously is signifying the fact that there is quite a concentration risk we're seeing here with AI. Obviously, we spoke about Nvidia last time with obviously their investment, but they have a 27% investment, and OpenAI actually lost around 11.5 billion this quarter. So their revenue was down and they lost. So therefore, again, buried in the fine print, it shows that Microsoft actually lost $3.1 billion from their AI investment into OpenAI. And they kept this extremely well hidden, which has obviously caused some concern for investors because it was very deep in the fine print. But actually, you'll find that there was an expense of 3.1 billion in their financial statements. And obviously, this is causing investors to worry because obviously we know that companies like OpenAI, and obviously you look at Grok and Perplexity, people use them day to day, but actually they are still yet to return a profit. So obviously it's causing concerns for investors over the actual stability and the financial sort of viability of investing into these large language models and these AI platforms, and whether actually they can maintain these investments or are companies losing out on them. And obviously there are talks of the potential investment with the Saudis for Microsoft to obviously effectively hedge against this. But I found it really interesting that actually they had really strong earnings from their core sort of competencies, their core segments, but markets weren't happy about that. But then also they managed to keep their OpenAI investment and obviously the losses that OpenAI have faced very well hidden, which obviously is quite concerning from a reporting perspective, from a governance perspective, from a finance perspective. So it's one to look out for and sort of keep an eye on in terms of these large sort of tech companies going heavy on AI and yet turning a profit from them.
Absolutely, very, very interesting, and concerning as well, as you mentioned, which is funny. And talking about AI, we spoke about this on a couple of episodes actually, which are yet to come out, but we are in an AI bubble, right? I think it's kind of plain to see, valuations, etc., etc. And the crazy thing is what you just said, they're yet to make a profit because of these high server costs. And I recently saw, I think it was this week or maybe last week, or it was definitely this month, Michael Burry going short on loads of the big AI sort of investments. And that should be enough of an indicator to see maybe the potential shifting sentiment from retail guys, but not from these big companies, and probably because they've got a part to play in it, so they feel a bit more bullish on it. But it is very interesting. Do you think that this is something that like AI will continue to shape Microsoft's performance and kind of their guidance? Or do you think that maybe we'll see something different, in early 2026?
Well, I think obviously they are still continuing to sort of double down on AI investments, obviously through CapEx and other investments. And obviously you see these large companies taking little stakes, and it gets to the point where it's just becoming a circle where everyone's going to own everyone. But obviously, as I said, how sustainable is that? And I think that will continue to sort of place pressure on these tech companies from an investor perspective, because as I said, this is a lapse in reporting. They've kept it very hidden. It hasn't been as transparent as obviously investors would like, and it's taken a couple analysts to go through the fine print and find such a sort of statement. And actually, again, another case of reporting. So their loss was of 3.1 billion was after tax. So before tax, effectively, we're looking at a 4.1 billion loss. So again, it's little changes in their reporting, and it's about the transparency of these tech companies and how they can actually, again, report their AI investments and overall return capital to investors. And obviously, OpenAI is struggling to do that as of yet. Obviously, there is the question: are we going to see these large language models and these platforms turning a profit? But I think for now, it's going to continue to place strain on these companies. And again, with large capex expenditure, if that's not going to make a return on investment, then we're going to see negative financials from these large companies that are so concentrated in these indexes and have such large market caps. It does create a question: are we going to see a massive collapse here? So it's a very difficult one to call, and I think we're going to have to wait and see for maybe in a year's time whether these companies can sustainably turn profits from their investments. But as of yet, they're struggling to do so.
I've actually got a question really quickly for Dylan. Just to talk on the ethical point. Yes, we know that it's not exactly ethical for them to keep it so buried and hidden in the fine print. However, they did actually say it within the fine print. My question to you is, even though it wasn't exactly ethical, can they get away with this? And because we know that AI is actually on the rise, would that lead to an increase in their PE ratio?
Yeah, so the thing is, they can get away with it because it is in their financial statements. So I think it goes to the point of the fact that obviously you have the transcripts on the earnings calls, and obviously they highlight specific areas. And typically analysts only really look at the highlights and their financial statements. And obviously it's like when you sign up for a current account at a bank and there's a fine print and a certain policy that you have to adhere to that not many people know. It's all creating so much sort of complexity from a governance standpoint and from a corporate standpoint that is difficult. And if you could repeat your question on the price to earnings ratio again, sorry.
Yeah, because we know that AI is actually on the rise and Microsoft actually uses it for its benefit. Would this then lead to an increase in their PE ratio, allowing them to be more competitively at an advantage compared to its peers?
I don't believe so, because obviously we're looking at their core earnings and obviously their stock price, and the issue is that all of their peers are as integrated into AI as well. So I think it's looking at it from a broader perspective, that all of their peers have a significantly higher price to earnings ratio, and all of their peers are making significant losses on AI at the moment. So if they are the one company that can actually make a return on investment and that increases their earnings, then obviously their price to earnings ratio is likely to rise. But I think for now, since they're making a loss, obviously it's creating pressures on their price to earnings ratio. But obviously investors aren't really looking at that at the moment. They're looking at their sort of top line revenue growth, which is what they're most interested in. And obviously, as I said, because these sort of factors and these investments into these companies are relatively hidden and not highlighted as much as investors would like, they're only seeing sort of the highlights, which is obviously what Microsoft want you to see, which again creates another question on governance and financial and corporate reporting: is how transparent should they be? Should there be a change in regulation in terms of what they report? Because it's very easy for companies to spin their losses and blame it on things like currency risk or tariffs. But obviously, is that the case from an operational perspective? Should you be able to mitigate those risks? So there's so many questions around it, but I don't think it will have a huge impact, seeing as the fact that so many tech companies are involved in AI themselves.
That's interesting. And you know how, I guess the wider sentiment we've been giving in this episode, like we've got a dot-com type bubble bursting, and then we've got, of course, the credit issue as well. So some dangerous times are walking into, and I guess we can wrap in some commodities on that as well with Gunvor's deal with Lukoil. So talk to us about that, Wahy, on a very high level then, and then we can get into a bit more specifics after.
Sure. So Gunvor is actually a major independent commodity trader.
Hmm.
Lukoil is a large Russian oil group, and they're under heavy Western sanctions currently. A $22 billion deal for overseas assets in both commercial and geopolitical. Now, Gunvor is rushing to acquire about $22 billion of Lukoil's overseas assets, mainly non-Russian fuel infrastructure and trading operations. Now, the company has really been warning of near-term fuel supply tightness during the transition of ownership, as contracts and financing structures actually get replumbed in this case. Now, the deal revives questions about Gunvor's historic links to the Kremlin and whether the transaction effectively extends Russian influence indirectly. Now, in financing such as when we talk about large syndicated loans and trade finance lines, these are actually at pressure in this case. Plus, you've got the market's impact as well when we talk about hedging in derivatives. And this comes all together in a package, you could say. And this is a classic commodity trader power play, as we like to call it, which means that secure physical assets that cannot be touched because of sanctions or reputational risk. Now, in the near term, the risk is operational, meaning that asset transfers and regulatory approvals can easily cause local dislocations in fuel supply and pricing. And for energy markets, the key question is whether this adds resilience, so that allows for stronger trading balance sheet managing, or does it concentrate risk? So is it too big to fill brokerage or sanctioned barrels as well? And for banks that are providing financing, exposure isn't just the gun wars credit, it's actually political and sanctions, and the risk that it comes with it as well. So any change in sanctions in their regimes or how they work could essentially freeze assets or even disrupt the flows in markets as well.
Hmm. Yeah, very interesting, and again concerning as well. And what are the broader implications for oil prices and trade flows as well?
Yeah, so for European policymakers in this case, it raises an uncomfortable question, and that is, are we simply rerouting Russian barrels through Swiss traders rather than truly diversifying away from them? And so when we talk about the FIC angle in this case, we talk about refined product cracks, freight rates, and CDS on trading houses. So we talked about clearing houses quite a while ago actually, but we're going to bring that back in here in this case, meaning that if the market doesn't like the risk structure that this gives, it will show up in those prices before it hits the headlines. As we know that in markets, the price you see is actually the price you get based on the information that you have. And when we link it back to economics, we assume that everyone has symmetrical information. Well, we know in the real world that's not really the case. It's actually asymmetric. So you can definitely see smart money actually taking a lot of profitability and actually liquidating their positions, while retail investors, because they have that lack of information, this asymmetric, you would definitely see smart money taking an advantage of something like this as well.
Yeah, and of course, we all love you using that term as well, as we are the Smart Money Show. But these topics have been great, and we are slowly moving on towards the end of the episode. So the next topic we have is, of course, Warren Buffett and his more non-investment strategy. So Dylan, of course, that's all you. Now, talk to us about his recent portfolio decisions, and then what is this non-investment strategy I've just spoke about?
Yeah, so I wanted to call it the non-investment strategy because it's in the name. He hasn't been investing. So for backdrop, Warren Buffett is one of the most successful investors of our times. He's roughly had an annualized return of 26% over the past sort of 60 years, outperforming the S&P, and he's been very good with stock picking and sort of contrarian investing. He's very big on valuations and balance sheet growth, and he holds companies like Coca-Cola, Bank of America, Exxon, companies like that. And actually, what Warren Buffett's Berkshire Hathaway has actually sold more than they have bought in the past 12 consecutive quarters. So actually, they are at a record cash pile at the moment of $382 billion worth of cash. And for an investment firm, that's sort of going against the remit, what investors expect. They want you to be fully invested to generate those high returns. But consistently for the past sort of 3 years or so, he has been saying that he is struggling to see opportunities in the market. And obviously we know Warren Buffett, he likes to invest in companies where he sees value. So he looks at things like price earnings ratio, price to book ratio, as I said, balance sheet growth. And that right now he is stating that he doesn't see any opportunities for companies that are undervalued. And obviously we know that obviously his partner Charlie Munger passed away, unfortunately, and Warren Buffett has decided to step down. And obviously we've got Craig Abel coming in, and obviously that actually caused Berkshire Hathaway stocks to fall roughly 12% since that announcement. But obviously there has been pressures on the company as a whole operationally, because they are struggling to find investments that obviously adhere to their specific investment philosophy. And Warren Buffett, he doesn't like to pay a dividend, and what he likes to do is buy back Berkshire Hathaway stocks. But even though Berkshire Hathaway stocks are perceived as relatively undervalued right now to investors, he still believes the firm is overvalued, and he said that he is not going to buy back shares until he sees a weaker price to book ratio. Which again, this is how he returns capital to investors, and he is refusing to do so as of yet because he doesn't see an opportunity to. And another way he returns capital to investors is through revenue growth and profits, which he is not doing at the moment because he is not investing into new companies. So they are still returning a profit from their current investment, but they're not looking for any new opportunities at the moment, or they're struggling to find new opportunities. And obviously this, again, we've had quite a sort of bleak episode today in terms of highlighting pure market risks and fears, but I'm going to bring another one. This is, again, scaring investors, because we have Warren Buffett, who is one of the most active investors there is, and he is struggling to find opportunities in the market. And obviously we looked at people like Michael Burry holding a really large cash pile. Warren Buffett's got a really large cash pile. And Warren Buffett has been one of those individuals that has been extremely good at reading the market and predicting what's going to happen. He was very conservative in the build-up of the 2007-2008 crisis. He had opportunities to buy various investment banks that went under, and he said no. So he is clearly extremely intelligent when it comes to finding these opportunities. And when you have someone of his stature saying that he's struggling and holding a really large cash pile, it creates the question of what we have next and what does he know that we don't. And obviously we have a new CEO going in, and this CEO is going in to the largest cash pile any corporate CEO has ever had to deal with in history. And that's not just to investment firms, it goes to any firm ever. So it's a really strange time right now that one of the most successful investors are worried about the market. And I think investors obviously do look at Warren Buffett's trading strategy and hold it in high regard. So obviously that is going to cause some pressure from retail, which obviously might cause a market decline in the future if we don't see some activity from Berkshire Hathaway.
Yeah, it's as you said, bleak. It is very bleak, and it's scary to see. And I'm saying the word, I think, for the third time this episode. It's concerning, but it is interesting from a speculated standpoint to see why. And I'm glad you mentioned his sort of thesis and the build up to the 2007-2008 crisis of actually, being more conservative. So, coming back to that, are we in a bubble sort of atmosphere right now? And when are we going to see the real repercussions of that, if there are any real repercussions of that, which we've seen in the past? But I think it's time to move on to the kind of final topic of the episode, which we're going to finish off strongly with a FICC related topic, which is Eurozone inflation is in a good place. Now, Wahy, it was weird to see this on the topic list, especially right at the end of the episode. Normally we start off with inflation and stuff, but doing our research into it, we realised that it is definitely relevant. So why don't you talk to us a little bit about what the latest data is telling us about inflation across the Eurozone and why it's relevant to FICC markets?
Well, considering it's been quite bleak, with us talking about systematic risk and all of the risk for investors, I think we should actually end it on a positive. And that's that the Eurozone's inflation's at 2.1%. And yes, it's actually at a good place. So headline HICP essentially means the harmonized CPI for the Euro area. You got the ECB's target, which is 2%, and it remains the same, similar to the Bank of England as well. So the Eurozone inflation fell to 2.1% in October, from 2.2% in September. So this shows that it's pretty much on target. So core inflation, such as food and energy, is at 2.4%. This is unchanged. Services inflation actually rose to roughly 3.4%, and it's the highest it's ever been since April. So the ECB's deposit rate was actually held at 2% for the third consecutive meeting, and markets price only a modest profitability of further cuts before mid-2026. Now for Q3, Eurozone GDP has increased by 0.2% quarter on quarter, which is slightly beating expectations. So growth is still weak, but not as collapsing as it was prior. Now, the talking part of this, we can say that the Eurozone is in the ECB's good place, as we mentioned. Inflation is nearly at target, and the growth is positive, but rates low enough not to actually choke or put the economy in a chokehold. The tension here in this case is actually the services inflation. So with a reading of 3.4%, it actually tells you that domestic price pressures are actually put in place, and it's still hot, even as goods and energy actually cools down. Now, we like to relate it back to FX in this case. So for FX, this actually matters because the ECB can actually afford to sit still, while the Bank of England and the Fed wrestle for higher inflation. And this is actually supportive for Euro USD and possibly even just the dollar in itself in comparison as a quote currency. So bond markets as well can interpret the data to say that, look, we're not looking for any cuts any further. You can carry into the Euro IG and peripherals, and it's still appealing as well for investors as long as growth doesn't actually roll over. And when we relate it back to the UK as well, the Euro area now looks like the lower inflation, the lower rate, more predictable look, which influences capital flows going into gilts versus spreads on corporate bonds. And I think I've asked myself a couple questions as well in this case. And one question I've asked myself is the ECB done cutting? Like with a target of 0.1% away from your actual target that you actually want. Are you going to cut any more, or are you going to keep it how it is? And I think the most reasonable thing to assume here is, for now, they actually are. And they're signaling a long pause, unless there could be like a structural shift or some sort of shock, supply side shock, or even a demand side, which could lead to potential deflation or even further risks to emerge.
Yeah, and again, I mean, you've given us the whole background and the forward guidance as well. And as you mentioned at the top of this topic, it's nice that there's at least something positive going on within markets. And I think we don't even talk about the ECB enough on our recap episodes, do we? So it's nice to give light to where I guess on the strong end of things. But yeah, I think that was an amazing episode, and thank you both. Of course, we covered a lot of topics and with high level, but of course a lot of forward guidance as well. Yeah. So yeah, amazing.
Yeah, absolutely. And as I said, always good to have 4 people on this episode. It just means we get to, converge opinions a lot more and have better conversations. So thank you both for that. And before we end up, normally you'll hear me talk about the outro of the episode now, but we've got a couple of announcements. First of all, from me and Naman, to our regular listeners, you might have noticed more of a gap between episodes. Normally we go every week, but the last sort of 2 or 3 episodes have been, bi-weekly, and that is something that we'll be carrying on moving forward. So you will see the Smart Money Show doing bi-weekly episodes, but we're going to be focusing a lot more on quality. We're going to try and focus to do a lot more in-person episodes instead of just online, bringing you inside offices and inside, the penthouse apartments of some of our guests as well. And the quality of these guests will be even better than they are right now, which is amazing. And we might, have more videos going out in other weeks between as well. But the main announcement, which we're very sad to say, but it's got to be done, this was actually Wahy's final recap episode, our Head of FICC, and he will be leaving the show and the team, unfortunately. he's focusing on some personal projects and, some personal circumstances, which is absolutely fine. We've absolutely loved his 10 years throughout the show. He's been amazing, and I think Dylan and Wahy's dynamism on the actual recap episodes has been amazing, and I've heard it from the feedback from our viewers and listeners. But Wahy, I think me and Naman just want to first of all say thank you, and that's number one, and just thanks for being part of the team and for helping build up a whole new team for the show. But also just want to give you the chance to kind of say a few words, because this will be your last time appearing as part of the show for the foreseeable future.
To start off with, it's definitely been an enjoyable experience, to genuinely say the least. It's been so enjoyable. From the recap episodes to even seeing guests appear on the show as well, it's been incredible. The network abilities from the Smart Money has also been amazing, and even having my own team of analysts putting out weekly articles, that whole experience was actually so enticing, because it allows not only analysts, you guys, to actually learn, it also allows me to learn from you guys as well. And with FICC in particular, because we're not just covering one asset, there's so many different things going on. And one thing that you have to be up to date with the news. But yes, recently there have been personal projects and other stuff that have to actually take priority right now, which is why I've decided to take a step back from the Smart Money show. One thing that I will say is it's been an amazing experience. I've loved having my own team. And it's a bit of a sad one, because I literally I did a whole hiring process for the new analysts. But actually, I've got a message for the new analysts. Yes, you won't be able to be under my lead. However, what I will say is, whoever is your new lead, which we'll find out very soon, they are amazing. In fact, I made a huge recommendation that they be the head of FICC. And I wouldn't have done that if they didn't do a good job at what they were doing. So believe me, when you find out who it is, or whenever this episode releases, they're an amazing head. I worked very well with them when they were an analyst as well. And I genuinely see that the FICC team is going to go very, very far. I see growth looking very long in this case, max long on the FICC side of things. With no systematic risk, by the way. We're looking at no systematic risk, so it's not going to be bleak at all. But no, all jokes aside, for my future analysts at FICC, even the future head as well, keep doing what you're doing. Work hard. Constantly ask questions. This is no place to just sit and be silent. This is a place of enjoyment, inquisitiveness. Like you have to want it, and this is definitely the place where you're given so much support. Time, and actually given the attention to detail that maybe a lot of people don't actually do, or even care about the small things. So yeah, my time here at the Smart Money Show has been amazing. It's been nothing but good things. Can't say one bad thing about the Smart Money Show. It's genuinely been such an amazing experience, and I can only thank Ali and Aman and Dylan and everyone else that's actually put an impact, whether it be helping me out or even helping the show out. You've genuinely made a huge difference. So yeah, that's what I'm going to say. I know I've been waffling on for a tangent, but yeah, take care everyone, and let's see what the future holds.
Yeah, and we genuinely appreciate you for giving time. Even I know with everything going on, even today was difficult. So again, the time you've given us today and all the hours and hours you've given us before as well, we really do appreciate it.
Yeah, and thanks for the kind words, Wahy. We'll pay you later. That was really, really good, actually. But all jokes aside, obviously, Wahy, the door's always open, and we'd love to have another conversation in future. But for the foreseeable, that was Wahy's last appearance, and that was the October recap episode for the Smart Money Show. So for our viewers and listeners, if you are watching us on YouTube and you haven't already subscribed, I hope Dylan and Wahy has given you an amazing reason to do so. Same goes to those of you who are listening to us on our audio platforms. You can drop us a rating and drop us a follow on either platform, and drop a comment if there's someone that we should be speaking to on the show that we haven't spoken to yet, or a topic that we should cover on the show that we haven't covered as of yet. Please do show some love and engagement on our social media platforms as well, where we announce some of our events that will be happening very, very soon. Actually, I know we've been alluding to it for a long time, but they are going to be happening definitely before the end of this year and going into early 2026, as well as some opportunities to join the team in the various departments that Wahy mentioned just briefly as well. So yeah, very excited for the future of the show and for some of these changes and these announcements. But as usual, we'll see you in 2 weeks now for the next episode of the Smart Money Show. Thank you, see you then, and take care.